Hello, everyone. Welcome back to the RationalInvestor.com's Broiler Chicken Show. Back. Or Vaca. That's a moo. Wow. Like we got to have the Vaca show. I was speaking with Vacas this morning, and I got to tell you, soon as there's one guy, and I don't know what it is. He has the most beautiful karma about him, but like literally, as soon as I start talking to him, I go right back into Vaca mode, and it's it's so awesome. So I hadn't talked to him since the trip. I had a nice little chat with him this morning, and I'm all Vaca gung ho again. Woohoo! If you know what Vaca is, great. If you don't, well, maybe you got to hang out a little more at TRI. I don't know. And actually, I got to be careful because Vaca, in some senses, can actually be like a swear word. So I got to be careful there. Anyway, hey, there's Nuri. We were just talking about you, Eddie. There he is. So hook up with him. Nuri, you're our Portuguese lawyer, aren't you? I think that's who he is. So I see we're doing this. We're doing no. Oh, okay. That's not you. Oh, I thought that was you. Oh, that's a different Nuri. All right. Anyway, it's Nuno. Oh, okay. I got it wrong. Sorry. All right. Anyway, we got to get you hooked up. We got to get those conversations going. So anyway, all right. So anyway, welcome back to the frivolity. I'm sure probably a lot of you are like, what the hell? Isn't he going to talk about markets? What the hell is he talking about? Oh, you figured it out. All right. Way to go, Eddie. You Vaca, you. Anyway, welcome back to the frivolity. We're doing the Zoom call. And of course, this kind of screws me up. There's the camera right there. Hi, everybody. Merry Christmas. Trying to sort of get settled back into the routine, if you will. We had a nice 2 or 3 week siesta there over in Europe. It was a lot of fun. In fact, I think I even did like shows. I seem to remember doing some shows from Europe. In fact, I did one show, and I couldn't believe it. As soon as I finished the show, I'm like, all right, we're done. And I turn around and everybody's like applauding. And it was like the weirdest thing because like you can see me there. I am in the background. Oh, actually, you can't see because the picture's distorted. But I'm just sitting in my home office here, and I just do this myself. So I never even think that there's even anybody watching. And it was freaky when when you have a live audience and you do it, and they're all excited when I'm done. So anyway, all right. So getting settled back in. Hello, Dennis. Thank you for the what are those? Are those high fives? Over there on YouTube. And of course, if you are on YouTube and you want to ask a question, feel free. I think I have that up and running as well. We've got the chat box open and running on the Zoom call. I see there's just a couple people. I don't know that there's that many people in this Zoom call or not, though. And you can always ask, of course, in the TRI lounge. We have that up and running here as we speak. Let's see if that'll load up. I think that was loaded. So there are a number of different ways that you can get a hold of me. Keep in mind that a big sort of reason why I did these Sunday shows was kind of to dovetail our level 1 education program, because it is, very, very steep learning curve. I do have a couple of years experience in the market, so maybe there's things that people have questions about that maybe, the instructors or the TAs might not have run into before. So it gives the students the opportunity to have some follow-up with me in that regard. Have to say I'm overly impressed, really, really impressed by the amount of interest in TRI. And I'm impressed that enough of you people heard my message that if you really want to get good at this investing game, you might as well invest in yourself while we're in a bear market and everything sucks out there, and get all the hard work done, and build your trading plan. Figure out what type of personality you are. So then that tells you what type of risk taker you are. And that's going to dictate what type of, activity you're going to be doing in the market. Take the time to actually figure out why the fuck you're even doing any of this. Ironically enough, a lot of people, they come to the market, especially when Bitcoin's like 50, 60 G's, whatever. Actually, what am I screen sharing? What are people seeing? I can't even tell what they're seeing. Well, I guess they're seeing the dashboard right now, eh? Yeah, okay, now I got it. And by all means, Chris, our show director, if you feel like chiming in here, if I'm not mistaken, I think there's a couple people on the site in the management team that would like you to participate a little more. So Chris, say hello to everybody.
Hello, all you happy people out there on YouTube and anyone here in the Zoom call. Hello.
Thank you, sir. I appreciate it. So I might, for feedback, because we're using the Zoom call and I don't even know if I'm coming or going half the time. I might reach out to Chris just to validate that, hey, yeah, you can see what I'm talking about or whatever. Or, even understand what I'm saying. Half of the time, I don't even understand what I'm saying. So I need Chris's help all I can get. But as I was saying there a moment ago, I'm overly impressed at the fact that we have as many people in the level 1 education program as we do. I mean, usually, like, I've been in the sales industry a very, very long time. You could make the argument that a retail stockbroker is nothing more than a glorified used car salesman. Of course, they're not going to admit to that, but at month end, if you haven't met your production quotas, oh boy, you're going to have that meeting with the sales manager, and you're not going to like it if you're not producing. They can be just as big of jerks as any used car salesman out there. Anyway, point of the matter here is, we had built this TRI place, and if you know my story, then you know my belief that my wife and spirit, Joby, James, my dear Aunt Doe, who actually technically is our little old lady from our education program. All of these people sadly have all passed, and breaks my heart to think about them. But point is, I think that, Jojo in particular, she said, Brian, you have the opportunity to really make a big positive change in this world. And I think we're actually doing it. So that's a big thumbs up. And just the fact that you people are here, you've heard my message and you're like, okay, Brian, I'm going to get serious about this. Let's quit screwing around. It's fun and all to listen to the YouTubers talking about their particular setup that they like. You trade this way, you'll make $1 million guaranteed. I mean, that's a load of horse shit. But you actually want to learn how to build a small business of trading with the complete understanding that you will never be right 100% of the time in this world. This universe doesn't work that way. So how do you set yourself up to succeed, knowing that you will, guaranteed, you will fail sometimes? So how do you set yourself up to succeed? Well, there is a methodology to this. And as I said, I'm just super, super pleased, super proud of the fact that I've been able to articulate the fact that, yes, you can do this. You just need to be taught how. And then the TRI team together has put together this great package with excellent educators that have lots of practical experience trading and making money from trading and running their successful small businesses of trading. And then all of you, to be perfectly honest with you, all of you, that you've heard the message, you didn't buy into the bullshit shill, and you're like, all right, Brian, I'm willing to come to you. I'm willing to learn. I'm going to put my thinking cap on, and for the next 12 weeks, I'm going to put my nose to the grindstone and work my butt off. And that's just to get started. I mean, the great part about it is, we do a show on Wednesdays. if you go to our free YouTube page, you can watch tons and tons of these videos. I'm not even quite sure how many of them there are in this particular, but this is our Wednesday show here. I don't know whether I'm showing you this or not, but hopefully you're seeing the YouTube page. This is totally free. I mean, there must be thousands and thousands of hours for you to sit and watch this stuff endlessly. And you can see we got a good, 500-600 people that watch the Wednesday show. But the point that I just made here is that one of my, and I'm constantly, cycling new site members and new students and stuff through the sort of commentary, my sort of co-hosts on this show. And one of the co-hosts that I have right now, the Romanian Nightmare, I mean, he basically learned everything that he needs to trade a very, very effective business, making lots of money trading from the level 1 program. So, I mean, it's all there for you, people. It's beautiful to see. Everything, everything is happening exactly the way Jojo said it was going to happen. It's freaky to see. Just if you are watching this Sunday show, just understand that a big reason why I do this is to sort of, help the level 1ers. I don't know whether they're actually done yet. They have their class on Sunday mornings. So actually, it looks like Shartokshi says we're not actually starting until next Sunday. So actually, we don't even need to do a show today. Oh, okay. Bye, everybody. I guess we're done. What I don't understand is how then do we have questions in this Broiler Chicken Show document? How did that happen? It's all good. If anything, this is probably perfect for you YouTubers. And what do we got? Oh, geez, there's about 30-40 people over there. If you have a question, please feel free to ask. You got my undivided attention now. So there you go. Cool to see that we have enough people here. I haven't really said anything of any value. Oh, by the way, I got to blow my schnoz. When I talk about spirit, I get all choked up. Hold on a second. I really should put myself on mute, but when I do that, but I haven't got a clue how to do this with all this Zoom. I mean, I've got like 10 different windows all over the place. I don't even know which one to hit. So anyway, you all get to listen to my schnoz. So, okay. What was I going to say? In the interest of diversification, in sort of conversation methodology. I don't know. Is that such a word? I don't know. Blah, 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 blah. I actually got that Rumble service up and running. So kind of on an aside, and it's something that I used to do when I was running my own 1980s webpage before I even knew Julian or Siort or any of you guys. When I was a broker, let's see, how can I show you this? I used to have this page up and running a million years ago. And actually, it's kind of cool that I still have the web archive and all that kind of stuff, so I can show you it years gone by later. I used to go by the moniker, the Canadian Rational Investor. And actually, even in Canada, you can actually even register your own domain names, .ca. And I had to give them the whole business model and who I was and blah, 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 blah. Oh, look at that. Maybe it's not even going to load now. Somebody killed it. Anyway, point of the matter here is I used to run a commodity trend advisory service. That's what this weekly commodity trend service little updater bullet here is. And what I've done here is, I don't know if I can show you this. I hope I have it here. I created a page over on this Rumble site. And what I want to use this for is I want to do this weekly commodity trend survey over here, just as sort of like a backup. I want to get used to using the platform, get comfortable with it. Look at that. I've earned a penny. Woohoo! I can retire. I'm rich. That'd be cool if that was like a Bitcoin, 8.01 Bitcoin. That would probably be worth something, eh? Anyway, so I've monetized it and the whole damn thing. But the point here is I just want to get up and running and using this. So just be aware. I think I put a tweet out to that effect yesterday. Yeah, right here. That I'm doing the weekly commodity trend survey over on this Rumble site, and take it for whatever it's worth. Anytime I start using these new platforms and stuff, there's always a learning curve. And it took me probably about 10, 15 minutes just to get the damn video up and running. And the first 5 minutes are like, come in, Zagreb. Hello, Zagreb. I am not a cat. All that kind of stuff. And then, because I was so frustrated because it kept telling me I was a cat. I probably spent about the first half hour, 45 minutes bitching and complaining about like the bankster elites and all that kind of crap. But the point of the matter here is that this should be a nice simple summary of and let's see, did this load? Hey, there it is. So I used to do this on a weekly basis. Just a nice summary of what I see happening in the markets. Right here, and you see, there's the US dollar, Canadian dollar. So I do all the currencies, then I do all the interest rate markets, then the stock indexes, then the metals, the energies, the softs, the grains, and the meats. And so that's basically what these videos are over here. Actually, I had somebody yesterday, and it was so beautiful because even in the tweet, I was like, holy crap, I ranted. I went way too much. I was swearing at that silly European central bankers. And I even had a dream last night that somebody actually called me out on calling Miss Lagarde a fuckhead. And I got into trouble because you're not allowed to call ECB presidents fuckheads. But what was really cool about this was like, even in the commentary, I was like, oh my goodness, it was just all right. And somebody even said, reply to this, we're here to listen to your crazy ass rants, Brian, so don't worry about it. And I thought that was cool. So, but anyway, I did get through the commodity trend survey. And frankly speaking, this, I think, is the easiest and best way to invest your money in the markets. Is you just simply want to identify markets that are trending. And we use a very simple moving average system to identify trends. And you know the old adage, right? The trend is your friend until it isn't. And so if you can identify trending markets and you just go with it, and then, of course, if you can identify trending markets that have things like lots of room to the upside to hit 50% objectives, well, that's what this now is. This is using less futures markets and more sort of stock markets because it's probably easier for us to manipulate the data for stock indexes. So you can see like all the commodity proxies, these are all stock market proxies. The ETFs, right? That stands for exchange traded funds. So, things like the euro currency, right? So instead of using the futures market, we use the ETF. So it's slightly different, but basically it's the same message. So I want this to dovetail that if you really want to understand what the trends are in the commodity markets, then really this is where you get your basis. Like I said, we start with the currencies, and in this message yesterday, you heard me say, currencies lead everything. And if you're here to learn how to trade and not here to, what I hate is a lot of people come to this site. I have my first job in this business was 1988. So what is that? In the 90s, the 2000s, 2000 and teens, and now +4. So that's 34 bloody years of experience in this market. And I actually have people come and say, well, no, Brian, you're doing it wrong. It's like, yeah, whatever. And actually, something that really disturbs me now, and I don't think the public sees this, I see they're walking into this trap, is I've literally seen this 2 or 3 cycles in a row now. that anytime the broader market goes into recessionary talk, everybody all of a sudden starts falling in love with investing in artwork, which is terrible. Like literally investing in artwork is worse than investing in like bulletin board stock. The art community is so insanely manipulated. It's horribly corrupt. I mean, have you ever seen any of the documentaries about people mysteriously finding Jackson Pollock pieces of artwork and then them having to go through the process of trying to validate that, yes, it actually is a Jackson Pollock. And it might be. Hell, you could even have a note from him himself saying, yes, I did write this. But if you don't have the right sort of provenance, as they call it in the art community, they will literally say that your piece of art is worthless. And now on top of that, what I'm hearing is people are saying that they're going to sell you shares in pieces of art. Oh my goodness, what a fucking fraud. I saw one guy who, when I listen to his YouTube videos, it's very canned, and every sort of, he is basically massive shill guy, and every single thing about his videos is, what is the hot topic, what is going to get people triggered. He was in love with Kathy Woods at the top of the market. Then he absolutely hated Kathy Woods at the bottom of the market. Poor old Kathy Woods. She's just a fund manager. She's just doing what she does. And if you understand the fund industry, that's the way that the Kathy Woods story went is exactly how all fund managers work. I mean, that's the irony of it all, is that there was nothing really out of the ordinary with her. She has this particular style. It works really well in one particular market state. Then the market state changes, and then she can't buy a friend. That's the way the fund industry works. So that's here nor there. The point is that now, because real estate is breaking, stock market is breaking, these shillers are looking for something, anything that they can shill in. Hey, nobody's thought about investing in artwork lately, and now all of a sudden I'm hearing all of these guys coming out of the woodwork that, hey, artwork is the place to be. And it's just like, what people don't understand is we've done this so many times over and over and over, and artwork breaks just exactly the same way. And it won't be the actual pieces of art that break. It will be whatever fund it is that you're investing in. Turns out it's a Ponzi. Turns out insiders are stealing money. It's the same fucking thing. This is unregulated markets. You're just asking for trouble getting involved in this. And what I would rather do, I mean, look at this chart. Just, this is what people are doing, is they're chasing yield. And they go, wow, look how much this is outperforming versus the S&P 500. But to actually make money in this world of investing, and this is what kills me, is that there is a really good investment product just sitting there waiting. And it's, if you've worked with me at all, and if you understand simple things like W.D. Gann and his 50% rule, you should see a situation here where if I just slowly accumulate, maybe the bottom here comes in another $5,000 lower, I don't know, somewhere down in this area. But at some point down the road, we are going to trade back to this 50% rule. And the question is, if I start accumulating down here, when that happens, will that be a doubling of whatever the average purchase price I have? And if that is the case, then I should be able to sell half of whatever I bought at this 50% rule and get my original capital back in my hands. And all of a sudden, boom, now I have a risk-free trade that can pay me for the rest of my life. I mean, that's the way you should be playing this game. And what I really hate, what I'm seeing now, of course, stock market's breaking. Nobody wants to buy Apple now, right? Nobody wants to buy government bonds. So what are we going to do? All right, let's go and find a product nobody's talked about. Say, hey, let's go and invest in artwork and how wonderful that market's going to do. And I see all these people all getting piled in. I mean, just even if you saw a chart that looked like that, you would know. Brian would be like, don't touch that. Don't touch it. Where's the reload zone? Blah, 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 blah. Same old, same old. So anyway, what scares me about this, and it's the same thing that scared me about this trend in the stock market that we saw a couple of years ago. This idea of buying partial ownership of an asset. I mean, I don't mean to be rude, but you never, ever go and invest in an asset where you don't actually own the asset. Okay, so where was I? Art is a scam, yeah. Well, I mean, I've never heard of art as a good investment. I really have never ever heard of it. And what I find really interesting is all of a sudden, all these YouTube shillers are all piling on the bandwagon about how art is a wonderful investment right now. And, you know, really what I would say is if you're going to invest in art, you should actually be investing it when nobody is interested. And the chart of your particular art asset looks something like this. The irony of it all, and who can finish this statement? This is the only business when stuff goes on sale. What? Do you understand this? If you don't, then you're probably doomed to just... Is this not the same as coming in and buying Bitcoin at the top of the market? Seems to me. I mean, they're all talking about how wonderfully uncorrelated art is with the stock market. I can absolutely guarantee you if the stock market breaks and the big boys on Wall Street and, you know, the guys who live, you know, in the fancy houses on Central Park, they have to sell and they need to sell, they will sell that artwork at whatever price they can get for it, and usually they get screwed over. So caveat emptor. I mean, the irony of it all is if you really want to do well in this world, you have to identify assets that have been absolutely obliterated. And that's when you actually want to go in and seriously consider investing. The scary thing about artwork is, can you please tell me what is the value of a piece of artwork? And I can absolutely tell you without a shadow of a doubt, you cannot tell me the value of a piece of artwork. There is no intrinsic value. It is purely aesthetic. So that means it's one of these games where it's just the greater fool's theory. So I don't like that idea at all. I think it's just asking for trouble. And the simple, and I hate to say it, this is the worst part about all of this. The fact that I'm seeing people coming out and shilling this idea, to me, actually means that you've probably missed the idea. The guys that have put together these companies that are selling you these shares in these assets, they're the ones that are getting rich. And think of it just like a shitcoin. It's the same damn thing. The guys that, you know, get together through the bear market when Danny couldn't buy a friend, and Colin and all his hero guys went and financed Danny at the bottom of the market when you couldn't literally give this crap away. And then all of a sudden everything goes all apeshit to the upside. They're the ones that did really well. Well, I would say it's the same damn thing here. So the guys who put together these companies to actually facilitate your investment in these projects, those are the guys that are going to get rich off of this. You coming in and investing at the top of the market like this, if this is particularly a chart, this is probably just a made up image. I think you're just asking for trouble. Anyway, typical Brian. I'm probably going to piss a lot of people off. But hey, you know me, I'm an open book. I'm just going to tell you exactly what I think. And when I saw this isn't the actual primary one that caught my attention. The primary one that caught my attention was from another guy. And I think that these guys listened to that guy. They saw, oh, hey, this guy's got hundreds of thousands of views and look at all the hits. And oh man, he's making a fortune using referral codes and all that bullshit. And they just jumped on the bandwagon. And now these guys are doing this. And I think this is just awful. I mean, ironically enough, you want a half-decent investment idea. I think, you know, I'm not necessarily saying Bitcoin's at a bottom here. We all know that we have to see a break of this trend line, then a W on the other side of the trend line for this to be a buy signal. So I don't have any actual buy signals here. But you need to identify assets where they've literally ripped it a new a-hole. And you're coming in and you're investing at value. Well, that's the way that I've been playing this game for 30, 35 years. That's the way these guys make fortunes in this game. And they do not make fortunes coming in and chasing up markets like this. So anyway. I'm not quite sure why I got off on that rant. It caught my attention today, and I was like, oh goodness, come on. I mean, there's a perfectly good investment vehicle staring you right in the face. And when we have our 50% bounces, probably the 50% level ultimately is going to line up with the top of value here, which means maybe we have another dump down here into cost of production kind of idea. But if you can just slowly force yourself to dollar cost average down here, anything below 20 G's and maybe down all the way down to 10 G's, we get a rally back up to 30, 40,000. You should be able to sell half on a double, get yourself a nice risk-free trade, and then just forget about it and just let your money work for you. But it's a very, very hard sell. This is the only business when shit goes on sale, nobody wants to buy. So go figure. All right, so looks like we got the YouTube page up and running. It's about 11:30. I mean, I can go into TA this, TA that. I mean, you can see what this image looks like. I guess, a couple sort of side issues. You want to kind of think of what value is in the crypto space. If you're going to try and time your purchases, I like things like this cost of production study. Usually I've found that these markets like to bottom at about, I'm going to say about 150% of sort of this area. I don't even know. Do we have S21s now? Do we have S23s? Do we have S25s? I mean, maybe we have even more newer generation equipment. This was sort of the cutting edge equipment back here. And, one thing that I did notice was that you see these numbers are around 3,000. We ultimately bottomed there at about 4,000. And down here, the numbers again, like I said, were about 1,000, 2,000, and we bottomed around 3,000. So here you can see, here are our S17s, S19s, all this. This is one gentleman on the website who I think he does very, very good work, and he is an excellent sort of proxy on the broader public market. Doesn't have things like economies of scale for energy, but is operating as efficiently as he can. And I think this is a great public sort of cost of production model. Regardless, now that we are down in this neighborhood, I hope you can appreciate the difference between this image and that image. I mean, they're apples and oranges. This has got trouble written all over it. This, I could still very easily see a nice little dip. I actually like the idea that the market comes down and maybe trades in some sort of big FU candle all the way down to maybe 5 or 6 G's and just freak everybody out. And then Bitcoin puts in one of these massive tails, a big hammer. We see that repeatedly in this space. I wouldn't be surprised if this cycle's bottom looks a lot like... let's give you a different image to look at. Bitcoin, yeah, I think it's this one. I think that this bottom's going to look a lot like this bottom. So this was a funny event. I remember this. This was the, and I think I have it right. I'm not quite positive, but I think we called this the Mike Hearn Rage Quit event right here. And, he was a lead developer, and of course the price was collapsing. And you can see, right, this bar started, and this is a weekly price chart. So beep, we start the week there at 268, and we tanked all the way down to 152. So literally the market in 1 week period, and you can see it, by the end of the week it was back up at 215 or so, and then the next week it popped up, and then the following week it was actually higher than that low. So this is pretty much what I'm thinking this bottom's going to look like. It's going to be uglier than sin. Absolutely. And I've always told people that Bitcoin tops and bottoms, they kind of have to, by definition, look like these insane moves, because Bitcoin can never finish a move, whether it be to the downside like that or to the upside like this, without some sort of horrendous blow off top or bottom. It's just the way Bitcoin seems to work. And if anything, if you think about the emotional nature of Bitcoin, it makes sense. You know, there's a lot of young kids that are very emotionally charged in this space. Like I said, Mike Hearn rage quit. We got lots of rage in this space. In fact, actually, I got to say, this cycle has actually been relatively quiet. You know, if anything, I bet the market was hoping that Do Kwon would go through some sort of rage implosion. And frankly speaking, I got to hand it to the guy. He's keeping a relatively level head through all of this. So, but I definitely think that we get some sort of big capitulation low. Then, ironically enough, I think the market actually just parks itself sideways. And I think you could actually make the argument, interesting, September. Does this look a little familiar? We're stair-stepping our way down. We've gone sideways for, what, about a month or two? And I think there's just one more dump ahead of us, and then the lows are in. So, ironically enough, you know, here we are, the end of September. Where's September? There's September, October, sort of in that area there. And you notice that, well, you know, if you just sat there and did nothing, September, October, November, 1 year later, that's actually where the market breaks out. And, you know, we start the new bull run. So, yeah, I think the market is going to be ugly. Benner cycle. If you don't know what Benner cycle is, I can see if I can quickly show you. Where do we have this? Let's go, actually go library. And we'll go to our blog. And Josh did such a great job putting this blog together. So this is what I was talking about earlier when I said, you know, the TRI team has really just incredibly outperformed. Everybody that's involved in this TRI experience, it's magical. It is so fucking magical. Sorry. It's overwhelming how beautiful this is. Because it's everything that I dreamed of happening. And it is happening. It's so fucking awesome. Sorry. All right, so, you know, 22, 23, we know that this is going to be shit. So don't force this, right? Don't fight this. There's no point in fighting this. If anything, when you fight this stuff, that's where life gets really, really frustrating. So just acknowledge the fact that 22, 23, going to be a shit year. 22 sure has lived up to it. So anyway, Benner cycle. What I love about this thinking is this aligns so perfectly because I don't know whether I did this over here, but I don't know. I've got another chart. It's just so fucking cool. Just give me a second. I'll see if I can load it up here. I get all choked up when I talk about this site. Man, I love you guys. This is just so fucking awesome. Okay, where are we here? I think it was this one. Yeah, here we go. So, you know, there is 22. So, you know, previous Bitcoin cycles, we had to expect shit. Previous Bitcoin cycle, we had to expect shit. Current Bitcoin cycle, what a surprise. We got shit. But notice, you know, if we think 23, we think, you know, halving event, we know that that's coming in, you know, sort of, let's say, first, second quarter of 24. Look how perfectly this aligns with this 22, 23 is crap. And then once we get out of 23 and into 24, you can see, and remember this was, I remember one guy we had on the site, Kavarkinator, he actually had the balls to step in and buy Bitcoin when it dumped against those lows. Totally everything that we teach. And, you know, you see the end result. That was this trade right here. And look at what happened. I mean, he was just a total boss. You know, just beautiful trading. So why fight this? I mean, I think we got these cycles pretty tapped. So there's no reason to fight this. And then, if we think about, we're coming into some sort of capitulation panic low here, anywhere along here, if we get any kind of like dump, I think it's actually an incredible buying opportunity. And I'm not, not even from a perspective that we're going to see the market go to new highs. I mean, keep in mind, does anybody know? Let's see if you YouTubers even know this. All right, so there you go. Hey, Connor! Now he says the average cost of production is $9,900. There you go. Oh, I love it. All right, so 99.84. You've made the call. I love it. That's great. S19 XP minor. That's what they're called now, eh? Let's see. Oh, so this was just P. So now we have S19. What did you call it? S19 XP. So there I'm sitting right there on this S19 at 84. But you're thinking at 0.08 for electricity cost, that comes out to about 10 G's, eh? So let's see what I had here. I had electricity cost 0.05. So let's bump that up to your price. All right, let's see. Ooh, that takes it all the way up to 13. Interesting. I guess this must be a little bit more efficient your XP must be a little bit more efficient than this guy here. But okay, so if anything, thank you, Cutter. Appreciate that. Long and short of it here, I love the idea that cost of production is somewhere around 10 G's. That makes perfect sense to me. Yeah, I see you over there. Thank you, Cutter. Totally awesome stuff. And I love where, this site, you guys are so fucking awesome. Then Brian's going to start crying again. Sorry. Okay, so where was I? Just try not to force the issue, but just look at it from this perspective. You want to take the next year or so, don't chase, right? Ironically enough, this image right here is what I'm actually talking about, where I think, where the hell is this? I think, naturally speaking, we should see a 50% bounce. And this is the thing that actually I'm really interested in right now. I don't know how many of you have been following, but you could make the argument. Oh, it's not off of this one. Darn. This one should suffice. Let's see what we got here. There we go. So you could make the argument that, this particular cycle, and this is what scares me right now in this space, right, is that I think 20 and, let's call it 18, 19,000. I think that number right now is basically the same as this 6,000 level that we saw back in 18 dump. And notice there was one more FU move to hit the ultimate low. But was there an interview or was there a video done, a conversation had that actually marked the bottom in this crypto market? Obviously, if I ask a question like that, well, they're tears of joy, Cotter. So that's the good thing. They're tears of joy, not tears of anguish. So it's a good thing. All right, so back to our story. Was there an interview done? Was there a conversation had that actually marked the bottom in this market? And obviously, if I ask, there you go. Somebody's cluing in. Obviously, if I ask that question, you know what the answer is. But what I found fascinating is, geez, I don't even know where we have it. Maybe in the Learn page? It looks like the school entry is over, so now you can't even get to that page anymore. We put it away. Maybe it's in the testimonials? No. Yeah, well, isn't that interesting? There's a cool page that we put together that promotes TRI that we show through the whole sort of marketing shill part of the of the thing, but I don't see it here, and I can't remember. Does anybody remember what the address is just off the top of their head? I mean, these look like they're testimonials, which is totally awesome. I love that. But maybe it's this page right here. Sign up? No. Oh, darn. Anyway, there is a page that I usually it's the link right here, but I'm not exactly sure what the web address is, and it's got the video that Dav we did. Does anybody know what it is? No. It is just. Oh, darn. Anyway, it would have been cool if I could have shown you that. I'm not quite sure where it is. Oh, darn. Can anybody help me? Anybody know what it is that I'm... Oh, there you go. Eddie. Didn't I tell you this Eddie guy is so fucking awesome? Oh, my goodness. All right, let's see what we got here. There we go. This is the page I'm looking for. This video, and this is so cool because, frankly speaking, this was the exact bottom of the last cycle's market. And I find it interesting, love Dav. I mean, he's a fellow Canadian, so gotta respect for our fellow Canadian. He went a little overboard on the shill there up top. I got a little upset at him over that, but it was cool. Like when I was in Portugal, there were a few sort of Dav fans in the group. And I said, you know what? Let's try and reach out to Dav and let's try and bring him back into the fold. Because, I mean, what do you think, folks? Does technical analysis matter? I mean, come on. We don't want to chase. If you see, bear divs and things like, I mean, what was fascinating about this study is that, I mean, the divs in things like RSI were just blatant. So there was plenty of anecdotal warning that, hey, we are closer to a top than a bottom. Ironically enough, I'd actually make the argument, if we start looking down at our indicators, notice, price is trying to make lower lows, but RSI is actually making higher lows. Is that a bull div in MACD trying to come in? Look how OBV is trying to W out here. So, ironically enough, this is the exact flip conversation where that everybody and their brother is going to be bearish here. And they are going to say, Bitcoin's going to zero. Well, it's a fraud. It's all a scam. Blah, 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 blah. And I might argue that would be the perfect time for Mr. Da Vinci and I to sit down and have another conversation. Because frankly speaking, I think we're a lot closer to a bottom than we are a top here. And this interview was literally had right here. So wouldn't it be cool if Da Vinci and I, every time we come up to a 4-year bottoming cycle, Da Vinci and I have a conversation on YouTube. And the reason why I mention this was because in this conversation, I specifically said that Bitcoin will trade back to its 50% rule. And just the move back to the 50% rule should be able to make you a lot of money. It might just be something as simple as I'm going to buy this 4,000 level and I'm going to force myself to sell half of the position when the asset doubles in price and I create my risk-free trade. And there is the 50% rule. You can see that the market comfortably traded to the 50% rule. And not only that, if you missed this trade on this particular bar, you had this bar to do it, you had this bar to do it, you had this bar to do it, and you had this bar to do it. So you can make the argument that this would not be that difficult of a trade to do. So I don't think that we certainly don't have any weekly W's yet, but hopefully you can see that to all intents and purposes, history is basically trying to repeat itself. That's what this image is. And this is what I find so fascinating about this. I'm not trying to reinvent the wheel here. I'm not trying to reinvent the wheel. I was taught this principle over 30 frickin' years ago. 30 years. Nothing has changed. This is why I don't want you chasing things like the art market, which is trading at like the highs. I want you finding markets that are down. And the question I have for you, each and every one of you, is can you understand, do institutional players, do they buy these up markets like this? And if you don't know the answer to that, then for God's sakes, put your money away because you are going to get fleeced. Very simply put, institutions do not buy up markets. They sell up markets. So does it not make sense? What does the public do in up markets? Yeah, well, this is just basic. Yeah, you're right, Eddie. It's basically level 1 material. It's impossible to convey to the public, though. It drives you crazy how hard it is to convey it. Okay, well, don't worry about Da Vinci. We'll leave that conversation aside. Jason, do you hear my message? Are we in an up market? We're not in an up market right now. We're in a down market. So if institutions don't buy up markets and institutions make all the damn money in this stupid game, what do you think institutional players are doing now? This is what you got to learn. And if anything, you also have to learn that institutions, I mean, just please try and understand this, but don't take any offense of this, okay? Institutional players are capitalists. Do capitalists by nature, do they have ethics? All right, I like that talk, DMAC. I mean, if you can, buying when other people are crying and selling when other people are yelling, it really helps a lot. I mean, but let's just, just don't take, it doesn't mean that you are unethical, but you have to understand, Joey Diamond, is Joey Diamond an ethical person? And we all know the answer to this. Does he have a shred of ethics? So, what do you think Joey Diamond is trying to get you as the public to do right now? And remember, he has no ethics. The entire staff, the entire board of directors of Goldman Sachs has no ethics at all. Did you not see what happened through the 2008 financial crisis? And not a single one of those sons of guns went to jail over it. Not one. So you have to understand, what do you think the message out of the institutional players is down here? What do they want you to do? If you really want to learn how to make money from trading, you have to understand this basic principle. It sucks because basically they're lying to us, they're cheating us, they're trying to steal from us, but that is what good capitalists do, and it's evil. Question ultimately is, do you have to be like that? No, you don't. But you better come to this with a clear understanding of how this game works. And what really bothers me, of course, is that the public, they don't want to hear this message. They want to come in and buy an up market, and they want to keep seeing it go up further and further and further. But and if anything, this artwork shill message right now is the perfect analogy of this. And I don't mean to be rude to these young YouTube kids, but basically they're walking into a trap and they don't even realize that they're walking into a trap. Where's that damn thing that I just had? I guess it was on the Twitter feed, wasn't it? Over here. this stuff. I mean, do you not understand that the institutional players, they're long from down here? And, maybe on this dip right in here, and it'd be interesting, I bet that's right around the .com blow up and all that. The problem with this is that this isn't really an image of what it is you're actually investing in. So, it just says contemporary art. What the fuck does that mean? Are you actually going to buy a Pablo Picasso? Not likely. Are you going to buy some sort of, I own a fractional share ownership of a mutual fund that owns a portion of this piece of art? Well, does that any guarantee that there's any value to that mutual fund? I don't think so. So I guess the point that I would just make is I see a lot of similarities with what they're talking about. Well, art is inversely correlated with the S&P 500, and you always make money when you invest in art. Well, that's the same fucking conversation as coming in up top here. And technical analysis doesn't matter. Buy up markets and you're guaranteed to get rich. Come on, you're making the same damn mistake. So anyway, point here is, I think the one good thing about Bitcoin, and I've said this repeatedly, is that at least with Bitcoin, and that's this conversation, is we can actually figure out what the heck one of these things is worth. That's this whole idea of the cost of production. If I was investing in corn, I'd want to know how much does it cost to actually buy a piece of land, get the lands to the point where I can actually plant seeds, fertilize, water, pest control, harvest, transport to market. What is my cost to do all that? That's basically what this mining graphic is all about. If I can invest in corn and it's basically the same or lower than what the farmer has to pay to actually grow it and bring it to market, I'm definitely interested in investing. But unfortunately, most of the time, commodities trade at a premium to the cost of production. And this is why, especially in this kind of environment, why it's so important for you to understand the cost of production. All right, and even down here. Because if you come and buy up here, Joe's mining Bitcoins all the way down here. Would he buy Bitcoins at these prices? No way. He's selling into the market. So, and that's the good part about Bitcoin, of course, is that technically it is a rise-only market. If you know how to play this game, it actually should be very difficult to lose money investing in Bitcoins. And so, with this kind of conversation, now we can add a little bit of TA, and that's this kind of image. How often have you heard Brian talk about, anytime I see the damn 78.6, the market invariably bottoms off of it, and I look back over time and I see a goddamn W comes in right off of that level. I mean, that's your technical analysis. Or we could talk about, anytime I ever see the market trade back down to the long-term POC, or the basically where everybody is long, there's no real point in the price going any lower. Uh-oh, now my battery just died on my camera, so now I'm going to have to do let's see if I can load up the battery and get the camera going on YouTube quick like a bunny. God, today's, and then I hit the wrong button yesterday and I almost blew up the camera, so I got to be careful what buttons I hit here. Can Brian do this without going crazy? He's trying really hard not to go crazy. Uh-oh. Come on, baby. In you go. All right. And then over there. And he's alive. Yeah, I did it. What sucks with these Canon cameras, though, is they just churn through batteries. I literally have a bank of 3 batteries, and to do that weekly commodity trend survey show yesterday, I had to use all 3. Oh, no. What have we got here? What the hell is this? Movie auto exposure. All right, I just want to get the camera going. All right, we got that, then I do that, and we should be live. Yay, I did it. All right. So, Brian and his crazy technical analysis. Also, too, this pattern here, this A, B, C, D, this is actually, if you were going to think of it as like the tide coming in and coming out. This is what they call harmonics. How does price move? How does the universe behave? Believe it or not, the universe actually tries to behave in a very what's the word I'm looking for? Interestingly enough, harmonic isn't too far off. Like I would say harmonious fashion. Like planets orbit in an ellipse. Look at the top of the planet Saturn and try and figure out why that looks the way that it does. I'm a big fan of Earth, Venus, Uranus celestial angle relationships. What happens when those three planets make 90-degree angle relationships and 120-degree angle relationships? It's quite remarkable. So this would be yet another example where really in reality this market wants to go from here down to here, but it actually has to have a midpoint consolidation to actually get to this point. It's harmonics. It's the way the universe acts naturally. So anyway, the point of the matter here is we have an excellent harmonic target here of basically right around Cotter's cost of production. Is that an accident? I don't think so. Also, too, we can make the argument that these markets move in incredibly predictable secular fashion. Is that a word? Secular? I don't know. Here was the first cycle that I came into, and just try and remember these kind of funny lines. 1 year of correction. Then actually starting the new bull cycle. When was the next halvening event? Where did my funny little picture go? Oh yeah, there it is. So halvening event. And then what happens after halvening events? And then, here's this next cycle. So 1 year of shit. Bottom to halvening event. What happens following halvening event? So ironically enough, this market is stunningly predictable. And I actually think that we actually have mapped out the future here very nicely. I'd say it's probably going to look something along these lines. And oh, by the way, there's that halvening event. So, we do our correction, then we start working our way up. And once we get into this window, of course, like we said with Mr. Benner, 23 is supposed to be shit anyway, but we're supposed to have a pretty good time once we get through 23 into 26. And then I think, if I'm not mistaken, Cotter's going to come on the site tomorrow and talk a little astrology. And somebody asked him tomorrow what's supposed to happen in 2027. Uh-oh. Look at... There's 2026 to 2032. Oh, Jesus, that's going to be a nasty trough. So, and then, interestingly enough, based on all of my teachings, 2035, this is supposed to be our next greed cycle peak. So it actually lines up really nicely with all of our projections here. And then, of course, okay, so, all right, we're thinking end of 23. It might even be like January 24 when this damn thing actually starts taking off. And then we go back to our little cycle study. And this is April of 24. So there is January of 24. And notice that's basically where Bitcoin launched. And interesting enough, remember in March of, I guess it was 19, maybe it was 20. That whole, shouldn't we debate mortgage or future? Shut the fuck up, right? And that incredible buy opportunity. And then what happened following that? So, everything lines up absolutely perfectly. The only issue here, though, is if you do listen to this and you do follow this, we're still probably a good $5,000-$10,000 overvalued even right now. So that's why I'm reluctant to say things like we've bottomed. I don't think we have. And if we actually look at this chart, what I think is going to happen here, we've had 1, 2, 3 tags of this trend line. So I think this trend line's legit. But I think what has to happen here is we're probably going to, break out through this, maybe even zip up to that level. And everybody and their brother is going to be like, that's it. This is the new bull market. We're ready to go. And it's a trap. And there's one more dump against these lows. It's interesting that I've drawn that October. If I'm not mistaken, our sort of cycle analysis is thinking that the bottom, and that's this, let's see if I can show you. This, where the hell is it? Just give me a second. This one, but this isn't the best image. It's a better one, but we'll use this. So notice this is midterm election year seasonal pattern from 46 to 2020. And this is second year new Democratic president. So that's basically Joe Biden. And you notice September, October, end of September, beginning of October, we put in a little bottom. We actually rally smartly through the beginning of October here in the stock market. So that's the bottom that I think that you're going to see, which causes this rally here. But the problem is, and we have a rule at TRI, and I really like this rule because every time it's tested, it always seems to play out. But I do not think that you will get any buy signal until you actually see. And it might even be pretty muted, right? It might be even just something like boop. But you do not get a buy signal until you actually see a W on the other side of this trend line, right there. So, and unfortunately, and I can show you tons of examples, unfortunately, markets will do this. They'll break out, they'll sort of hoodwink you, and actually you could even make the argument this is what happened here, right there to there. So boom, 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 boom. Break the trend line now. Give me a W, please. And notice there's just no W's here. Even this big honkin' rally, still no W's. Boom, we just made a new low. Then we're finally getting a W come in over here. The only problem is it's coming in against this trend line. So, just this image right here, what I'm worried about is we get, relief rally. Everybody goes rah, rah, bull, but we don't really have a buy signal here. So that's kind of what I'm worried about happening right now. And then kind of as we talked about that before, the cost of production is really down in this area, I think. So, what I'm worried about is that this is another one of these kind of scenarios where everybody's going to be sort of lulled into thinking, yeah, 18, 17, 18, 19,000, that's our floor. And then boom, one more final puke out down into that $9,000, $10,000 number, and that ultimately marks our floor. And this, this final event just literally breaks the back of the noobs coming into the space. And at this point, this is where I did my fun little interview with Da Vinci, and the scuttlebutt in the space at this point right here was Bitcoin had to trade back down to $1,000. Not, it might, not, well, I don't know, it could go back and forth. Not, well, my opinion's useless, I just trade setups. The scuttlebutt was this had to trade that back down to $1,000. And of course, that was wrong. Typical. I'd also say too, that once we do get beyond 78.6s, I'd be very, very leery about putting on new shorts. I just don't think it's that profitable. And what ends up happening, like I said, I've seen there is 78.6 off our current range. So you can see it's not that far away. I could very easily, kind of like what we saw with this, and really with this, I could very easily see we puke out, maybe dip down into 88.6, and guys are like, yeah, this is a great short, this is a great short. But just remember that you're staring at this in the face. And this is WD Gann. If you don't want to listen to Brian, that's fine. I don't care. But this level here, and it's really predicated on wherever the ultimate low is, but this level here is actually what, if you're thinking about shorting, you have to think that this is actually the natural level that the market wants to trade at. It's kind of the same thing as this, you know. If you, it's literally the exact opposite, right? So if we go 50% rule, if we're sitting up here and you're thinking about buying, you have to look down and go, where's the 50% rule? It turns out it was here. So market comes down, hits 50% rule, then it can actually do something stupid like actually go to make new highs. That's actually not unrealistic. But just the point here is that I'm trying to make to you is that going short down here, you're actually asking for trouble considering where the 50% rule is. And so I really don't like the idea of coming in and even tinkering with the market down here. I think you're asking for trouble. And, you know, as I've said, you know, and actually a really good commentator on this, a gentleman by the name of Simon Dixon. Don't really hear him too much in the public spotlight anymore. But he used to always come out and just simply say, and, you know, I think he did very, very well off of Bitcoin. So I can understand why he doesn't interact with the public anymore. But you could very easily, come on, you. Anyway, somewhere up there. He would come out and say, anytime you see Bitcoin correct 70 to 80%, and that's, of course, one reason why I love that 78.6. Let's say 80. Right? We'll just use that as your magic number. He would just simply say, you got to get in there and buy. Now that the fluff has been taken out of the market, there is 80 right there. So where is that? Oh, what the hell happened? I screwed that up. Let's try that again. 80. Okay, what am I doing wrong here? There's 50. Where's 80? 0.8? What did I do wrong here? I lose all my wonderful inertia. Oh, it's going the wrong direction. That's why. All right, so where's 80%? Boom. Boom. All right, anywhere 16,742, you got to start buying. And anything down here, this shit's on sale. So, how ironic, right? As I said, what's Joey Diamond going to be doing? Does Joey Diamond own the government? And this is where it gets really scary about our society. Does Joey Diamond own the government? Let me ask you a question. How many U.S. Treasury secretaries over the past 50 years have come from Goldman Sachs? Does that not mean that Goldman Sachs owns the U.S. government? I'll let you answer that. I would simply say that the U.S. government is actually an agent for these institutions. The U.S. government, and really all governments to that effect, are agents for the oligarchs. That's basically how our society works. So, and this is where it gets really bothersome, and this is probably where I'm going to start getting strikes, and all of a sudden, mysteriously, the YouTube feed will stop working and all that kind of crap. But let's call a spade a spade. Is the government working on your behalf? Is the government working in your interests? Sadly, unfortunately, the answer has to be an unequivocal no. What I would say is, when I was a financial planner, we had a simple rule. Tax avoidance is not illegal. Tax evasion is. So most financial planners, when I was working in the industry, they spent a huge portion of their careers doing nothing more than advising on how their clients could pay the least amount of taxes possible. Tax evasion is illegal. Tax avoidance is not. Now, you would have thought if governments were working on your behalf, working in your interests, they would make this whole taxation thing relatively easy. I remember there's guys in the past that were always advocating for a flat tax, which would be very, very simple. It would simplify the process immensely. I might argue that half of the reason why the tax system is convoluted and is sort of screwy as it is to undermine the public's sort of confidence in being able to be in control of this situation. And frankly speaking, when I look at the way the tax system works, it's a joke. But it's put in place to make sure that you are confused as hell as a citizen. You don't know what is up and down. I mean, you would have thought that had our society was working correctly, that you would have government officials that would come out and say, here's some help. This is how you should file your taxes. And these are the laws, and this is what we expect of you. But there's none of that. They make it all incredibly ambiguous so that you actually fall into traps. It's kind of sad, really. So, please, I hate to say it, and, keep in mind, I've been working with government with my son and all of that. I have yet to see that the government people that I work with have any interest whatsoever in maintaining our family unit, in maintaining the cohesiveness of the father-son relationship. It's always, what is their legal obligation because Liam is a citizen and because of our socialized medical system, they are legally obligated to do things. And that's the only thing that they care about. So, it's kind of a sad commentary on our society, but make no mistake about it. The government is not there working on your best interests or to try and help you. They are working in Joey Diamond's best interest. I mean, how many of those banker crooks went to jail for the 2008 fiasco? And I would make the argument, which I have repeatedly, that all of this inflation and all this conversation that you see about how fucked up our world is right now, it was a direct result of this quantitative easing program, which did nothing more than just help the banking sector. It didn't help Joe Sixpack at all. It helped the banking sector. And like I said, not a single one of those bastards went to jail over any of that. And yet, I've repeatedly said, and it's probably like a lifelong goal of mine, that I should write a book about what quantitative easing in the 2008 financial crisis, the way that it played out, this was basically the crime of the millennium. I can't think of a bigger crime that was committed right across the globe to ensure that humans stay slaves to the banking sector than what we just saw with that U.S. banking bailout. It's tragic, really. It kind of makes you sad. Maybe this is, I have to be able to convey this message, and this is the message that JoJo really wants me to try and convey. And as I was barking away about in that weekly commodity trend survey video I did yesterday, half of my job here, hopefully, is that this message somehow resonates and sticks around. And, 20, 30, 40 years from now, when we're right back into the same situation, next go round, the banksters can't get away with this crime the way that they have. I'd also argue, too, that Bitcoin itself has been, in my eyes, one of the very few ways for you to actually have offset the hyperinflation and basically the destruction of our collective standard of living because of this quantitative easing and, bankster crook bailout. And ironically enough, when Bitcoin price goes down, just back to cost of production and all that kind of stuff, all of a sudden now nobody's even the slightest bit interested in this. Why? because really all they're thinking about is chasing up markets and chasing the inertia. And, you know, half of it is about sort of jealousy. Other people have gotten really rich. And it's more like, well, if they got rich, then I just want to hop on and maybe I'll get rich too, I guess. I'm not quite sure. So anyway, I would actually argue Bitcoin right now and over the next 6-8 months, as I've said repeatedly, I think is actually entering into a buying window. Which is ironic, because I spent week after week after month after quarter after year saying don't chase, don't chase, don't chase, don't chase. Technical analysis matters. Bearish divergence, don't chase. Now the markets come back down to earth and there's nobody watching anymore. Now is when you should go, all right, there's no more fluff in the market. I can actually start going and doing things like dollar cost averaging. Anyway, go figure. And what's also interesting too, I find, is that, I don't know whether you've noticed or not, but the 1% very rarely ever shits on Bitcoin. And this is because I think that they know Bitcoin is actually very good. I hear constantly them shitting on stable coins, on DeFi, on shit coins, altcoins, whatever the fuck you want to call it. Right? But I never hear them shit on Bitcoin. So I do think that that is a small tell that you're probably going to find Joey Diamonds and all that kind of stuff. They are going to be all hell-bent on freaking out about stable coins, right? And I wouldn't be surprised if that Tether thing has to go and fucking blow up again. Because Tether, I think it's a ticking time bomb. And that will be the way that they freak you out into selling your crypto and selling your Bitcoins and selling all your exposure, and it's all a scam and stuff like that, and yet those bastards are in there buying up all your coins that you're selling. So anyway, there's a nice big fat rant for you. 12 minutes past 12 noon. Whoa, interesting time. I think there was only one question for the BCS because, like I said, I think the education program actually starts next week for the level 1ers. So we'll pop on over it. I'll see if I can help. I don't know whether I can or not, but once we're done this, then I have to go get pretty for the boy and see if I can give him a fun afternoon out there in Lower Mainland. So let's see what the hell was asked. On the 2nd of October, which I think is today. Yep, there it is. Not sure if you answered this one already while you were in Portugal. Hi, BB. You've been saying equity prices are cheap for a while now. Relatively speaking. That's the important part. Relatively. Well, I get that adjusted for M2 money supply, equity appears to be cheap. Something just doesn't add up. Earnings in PE is also dominated in debased dollars. And PE is not cheap by historical standards. See graph below. Y-axis equals PE ratio. What am I missing? Okay, let's see. How would I answer this? I might ask, what are these prices relative to interest rates? Because I don't actually think that interest rates are overtly high right now. I'd also be interested too, I think this was 1980, right in here, where I do believe that interest rates were very, very high historically. In fact, at astronomical levels. I would also say that I believe that, how do we say this? I think this is ultimately a good contrarian indicator. So when PE ratios were at absolutely stupidly, insanely high levels, that was a function of just no earnings whatsoever. I think that's how I look at it relative to stock valuation prices. Ironically enough, down here, stock valuations actually were very, very low. So there is that component in here as well. Just the way that and the problem here is that, God, it would be interesting to adjust this data to the M2 money supply. That would be an interesting debate. Because, actually one thing I did see, which was fascinating, was somebody did a adjusted money supply study from the very first day of the Fed, 1913. Now, unfortunately, on sites like TradingView, if you do a study of money supply, maybe I'll do this just as a new one. Unfortunately, at TradingView, and keep in mind, 10, 20 years ago, this information was impossible to get. But if we do something like DJI divided by M2 money supply, you'll notice, whoops, what the hell? That's not what I wanted. Let's go over here. DJI divided by M2. You notice, it doesn't go that far back. We start this study at 1981. Actually, that's not bad, at least all the way to 1981. I would like to see this study going all the way back to 1913, the start of the Fed. And somebody did that, and it turns out that actually the stock market is almost flat through the entire 20th century. So I get what I'm trying to say here is, these are extremes. So obviously there's your .com top of the fierce greed cycle extreme. And that probably aligns nicely with this, mind you. No, that would be that top there. So here's kind of an interesting comparison, right? This was the 2008 financial crisis. Were stock prices materially higher through this window here? Not really. This was more a function of earnings absolutely collapsed. So stock prices, ironically enough, like if you look at 2000, right? So there's your 2008. Stock prices actually were about half. Or is that half? I don't know. What is that? That says 251 and that says 192. So not quite half. Like maybe, I don't know, what is that, 50 points? So about 20, 30%. So like 60, 70% of these highs, right? Say 70, 75, somewhere in there. And yet that PE ratio was through the roof. So what happened here? The actual earnings of the companies absolutely collapsed through this. So this image here is a little deceptive, right? You would have looked at this and said, wow, stock prices must have been so high. But really, this is a function of earnings. And if anything, the fact that the PE ratio went up as much as it did and stocks actually were lower in price actually means that the earnings destruction here was even greater than what this image is actually telling you. So I don't know whether this is a really good measure to use, to be honest with you. Through the 2008 financial crisis, this should, in my opinion, have actually been the exact same event as, and we can't even see it, but that 2008 financial crisis should have been, and you think about it, 2008 minus 80 years. Where does that take you? Well, 1928, 29. So this is what should have happened through that. That as the earnings, and as your image points out, right, earnings absolutely collapsed. then the banksters went and just threw bucket loads of money at the market and bailed out everybody. And then all of a sudden, the earnings streams of all these big financial corporations that technically were bankrupt, well, all those earnings streams came back online. AIG was bailed out. General Motors was bailed out. General Motors should have gone bankrupt, right? In this world, General Motors would have been kaput, would have been wiped out. So they threw a bunch of money at the market. So earnings stabilized. And then you actually started to see earnings actually start to increase. And I think you can make the argument, now that, where's 2008? 2008's right here. I think you can make the argument that, this should have gone down and it just should not have come back. But then they started the quantitative easing, printing money, bailing out all the banks, and in essence, stock prices started to rise. What this image is actually telling you is that earnings actually were rising at a faster pace. Let's see, I just got to make sure I have this right. Well, stock prices are rising here, but earnings are actually not rising as fast. If anything, this is a little scary now that PE ratios are starting to get up. You can make the argument that there just a year or so ago, PE ratios were approaching the dot-com boom peaks. So this is very, very fluffy. And if you look at, if we go and look at the stock market in real terms, right, divided by M2, you can see, there is the financial crisis peak. There is the market under Donald Trump getting prices back up into that level. You notice that, of course, the PE ratios went absolutely bonkers when the stock market collapsed. I think you could actually make the argument your stock market peak is actually these troughing points. So you might make the argument that we've worked our way back up into sort of dot-com vulnerable levels here. This is a little bit bothersome, but they're actually cleaning it up right now. PE ratios are starting to come back down because stock prices themselves should be coming back down. That's what this is. And yet earnings are actually relatively stable. That's probably the way that I'd look at it. I think what happened here is you probably had a massive expansion in earnings multiples. Remember, this is adjusted for money supply. If we take out the money supply adjustment, notice stock prices went to new highs, right? Booming higher. So you saw that multiples started to expand dramatically. And of course, NASDAQ, it'd be interesting to see what the NASDAQ looks like here. This is all the tech earnings, all that crap. So there is that boom. But look out, you can make the argument that NASDAQ has done some serious correcting here. Right, and they're calling this right now the tech wreck. But fascinating, we talk about 50% rules. Could you make the argument that actually maybe the NASDAQ has done its correction? Looks like it's getting close to being done. It's no longer, hopefully, this, if anything, what a beautiful trade, right? There is the short right there. All right, what are you supposed to think if you see the market smiling at you? Do we want to come in and actually be aggressively shorting here? I don't think so. Now, interestingly enough, if we look at this versus M2, there's Donald Trump's peak. We've actually gone beyond that. We're approaching, in the NASDAQ, we're actually approaching these crisis levels that, Chair Powell's like, well, you better go and approve a whole bunch of government bailouts for us or else the whole economy is going to collapse. Well, I don't mean to be rude, but geez, we just broke a key level. Here we are. We're right back down into that area. Now, I might argue that, buying against the bottom ends of ranges, that's what I do as a technician. So, reload zones. This is kind of the same kind of conversation as Bitcoin. I might argue that stocks are actually looking a bit cheap right now, aren't they? Yeah, we want to do a chaos off of that top. Might be interesting to see what that gives us as levels. Probably that range right there, right? Mind you, there's also this one. So that's a bit... This is where I'm still sort of... I don't know exactly how to do this. Oh, yeah, there's 4669. So that's interesting. Now, if things really start to fall apart here, look where 877 is. And check this out. What happens if we go something like, I don't know, maybe that low to that low? I don't know. Maybe even that low to that low. Maybe we got to trade down into here. I don't know. So I guess what I'm trying to say here is if you believe that this pivot was a key pivot low, and if we go back to our PE ratio, that would basically be this low, eh? No. Or maybe it would be this low. I was just put in. If you believe that low is for real for PE ratios, then it means that this low holds. Unfortunately, it would be nice if we had date references here. I think that that's that 20 low there. Notice that cute little M right there. Let's see, does that line up with that? Oh, darn. Yeah, I can't see where it is. Maybe. Oh, not that one. So yeah, it's interesting too that I like the idea that the market wants to pivot off of this 4669. I'd be really surprised if we dump through here. Like all my projections and all that kind of stuff say that we go like this, like that, and then like that. So it is interesting that that 4669 happens to come right off of that level there. And it looks like we're losing that. So let's see if okay, now that I've just barked for about a half an hour on all that, let's see if this makes any sense. We'll ask the question again. You've been saying equity prices are cheap for a while now. All right, that conversation is all about... It could be either one of these. Let's see. Not that one. So this one. Yeah. So this is what I think they have in store for us. So there's your dot-com boom way up there. And this is raw price relative to the money supply. So there is the 1929 stock market peak. There is the dot-com peak. This is the greed cycle. And this is the fear cycle. I believe that we're sort of like right in this area. Now, we might be further along. We might be in this area, but I think we're actually still right here. I don't know. That's a tough one. But I think we're somewhere down in this area. So when I say cheap, what I'm really saying is relative to this study. I think, we're not at the bottom. Remember, there's 1980, that bottom there, and the stock prices there is the top. I mean, ironically enough, I maybe, considering where we are there, you might say, well, Brian, I don't think we're at the bottom end of the range. It looks like we're right at the 50% rule. Is this cheap? Or is this just the median? So, I could understand your logic in saying, Brian, I don't think we're actually quote unquote cheap. If we were cheap, we would be down at your 78.6, 88.6 down here. That's cheap, where we traded to back in January 2009. And we're still quite a bit off of those lows. You know, so there's 2009 low, right? The converse, and keep in mind, this is a PE ratio. So when stock prices are really, really cheap, but earnings have absolutely collapsed and the company's earning no money at all, you might have stock prices themselves really low, and probably the Dow one's better than the right here, right? You might have stock prices themselves really, really low, but if their earnings are basically zero, you're going to have a PE ratio that's through the roof. So this is a tough chart to use to measure relative cheapness and relative expensiveness. In a weird sort of way, I'm almost getting the impression, I mean, and this is difficult, right? Because is this the 1980 bottom? And if that's the case, I kind of like going long through that. Is that the 2000 dot-com bubble peak? All right, well, I like to go short off of that. Then we had the 2008 financial crisis. Stock prices were not high. And if we go back to that image, right, 2008 financial crisis, that's that right there. On a real dollar terms, we were still a shadow of our old highs. So stock prices through here were not actually really high. The reason why this is going up like this is that earnings just absolutely collapsed. And really, what should have happened was we should have had another Great Depression. That's what should have happened. You know, this whole quantitative easing thing was just all smoke and mirrors just to get the banks off the hook. Right, where's that? Not weird. Why does that not show? DJI? Should work. There we go. So, you know, I actually make the argument that really, instead of the market going up like this, the market actually was supposed to go down like this, and we were supposed to go sideways. So, is this a real image? No, actually, I think the real image is that. And my argument from a cheap, expensive perspective is this, in my opinion, is expensive. And this, and especially this, is cheap. I can understand you saying, well, Brian, okay, that's fine and well and good, but are prices actually cheap right now, or are they just sort of middle of the road? And that's their 50% rule. And it kind of looks to me like actually you could make the argument that stocks are actually not overvalued and they're not undervalued. They're just done absolutely nothing. So that's probably the way that I would look at this. And when I say relatively cheap and relatively expensive, I guess what I'm thinking about is this image. You know, I don't know whether you heard that Carney guy. He publicly came out and said that he expected $100 trillion in financing deals for this whole move away from fossil fuels. $100 trillion? That's crazy. Is it that the world, I mean, and also think about it through here. Like in this world, they were thinking in like millions. But in this world, they're starting to think in like tens of millions, if not billions. And these people over here go, how on earth do you see a world with billions? Well, the answer is the essential planners just went on a massive money printing scheme. They go on that massive money printing scheme. And all of a sudden there's bazillions and gazillions of dollars all floating out there in the system. Those dollars get put to work in new ideas, Amazon's, Microsoft's, whatever. And eventually, the money multiplier effect, all of that money sloshing out of there in the system, money multiplier effect, all of a sudden, companies are going to start earning more money. And I might make the argument that through this period, you probably actually saw, and I can't say this for certain, but my gut feeling is that PE ratios were probably relatively low here. They moved up, but you'd almost have to say that the slope of the PE ratio moving up would be stock prices probably moved up more than PE ratios. But then when you get to the very end of the curve and the very end of the cycle, then PE ratios, you get that what they call multiple expansion. And the PE ratios start to go absolutely insane to the upside. Insane to, oh God, it's so difficult. Earnings may not grow at the very end of the cycle as fast as they grow at the beginning of the cycle. So as a result, you get PE ratios that spike. So like the dot-com boom, right? Heading into the dot-com boom, then the recession happens, and the PE ratios have to come screaming back down. Then we start the war on terror and all that bullshit, and the market starts expanding and heading higher, all the dot-com. There was a big quantitative easing program in through the dot-com days. It's just relatively speaking, it wasn't as big as the 2008 financial crisis, so nobody ever talks about it. But in essence, once we, I might argue that this was probably the top of this sort of valuation move. Then PEs actually start to go up because they justify expansion of PEs through this multiple expansion. Well, the industry's growing, and Nortel Networks through the dot-com boom was a perfect example where PE ratios were going up. In fact, Nortel never had any earnings. So not only did they not have earnings, their earnings were negative. So what the hell PE ratio is that? Had a company only had like a penny of earnings, but the stock price goes booming higher, well, the PE ratio is going to go up. So the stock market gets thumped, the whole dot-com boom unwinds, then we start to see the economy start to firm up, earnings start to get better. You actually hit your peak sort of valuation window here. Then you start to get the PE expansion where earnings don't actually go up, but stock prices get bid up to new highs. The public's coming in and buying the top. And somewhere right in here, the market breaks and we have to go through the whole damn thing. The actual earnings collapse. Stock prices are still high, so you get these ridiculously high PEs. Then stock prices have to start correcting. Then earnings start coming in line. So this is a very difficult image to use to describe that because there's multiple phases of the economic cycle that affect this image. And ironically enough, at the very end of bull markets, PE ratios actually start to go up dramatically because of this multiple expansion thing, even though earnings themselves actually start going into divergence. So long and short of this, half-hour rant here, I don't think this is a good measure to use to judge valuation in stocks itself. I've never really been a fan of just PEs on itself. If I'm going in there and I'm buying value, I want to look at things like price to book ratio. I want to see how much debt they have outstanding. I want to see a positive PE number. It's a combination of all those. I want to see how many shares are outstanding, what's the relative market cap of these companies. I mean, if anything, something that's got to be a little disturbing, that's sort of like the end of the line move, is, you know, just if we look at something like Amazon, it's a pretty good example. I mean, look at the market cap on this thing. It's $1.1 trillion. I mean, if you buy a company like that, you buy one share of this, what's the percentage of company you're actually buying? You know, I spend $113. It's an incredibly small number. Interesting too. Look at the huge difference in PE ratios just from current PE to anticipated forward PE. So where does that fit in on this curve? This is under the assumption, I mean, quite literally, this is under the assumption that that the company's earnings are going to double next year. And you can see, you see earnings this year, you see earnings next year. Now, is that realistic that a $1 trillion company is actually going to be able to double their earnings? Have you seen what's going on in China recently? Have you seen what's going on in Eastern Europe recently? Have you seen the unwinding of Great Britain? Do you think a lot of British people are out spending tons of money right now? So you have to ask yourself with these PE ratios, is this maybe as good as it gets? And where does that put the company on your scale here? I mean, are we up in this 120 area? So, I don't know. I guess my answer to this is I don't know whether I would use this as actually a good gauge of quote-unquote value. And ironically enough, you know, looking at this image, what I see here is on a price to earnings basis, kind of what we said there a few minutes ago. And kind of when we look at the stock market itself, probably not, well, even this one too. I don't know. I get the impression that we're almost kind of like middle of the road, eh? That's 61, so that's not even 50%. You know, maybe we're just sitting right in the middle. There was dirt cheap, and there is kind of middle of the range. Is that maybe the same image as this? You know, there's dirt cheap, these W's. This is panic ridiculousness. And if anything, I'd almost consider this a bit of an anomaly, but it's probably a really good analogy. It's interesting that we don't have PE ratios going back into the 20s, but it might be interesting to see. I mean, maybe that's the Great Depression there, and maybe this spike up top here is the same image as this. So that high there corresponds with that high there corresponds with that high, this high here corresponds with this high. You can see how we're probably going to have to dip against these lows, which means this number probably is going to have to come back down against these, that low, and that low, right? Which would be that low, that low, that low kind of idea. And then we spike all the way right back up to the top end of the range, probably into like 2026 kind of idea. And then we have another big wipeout, but maybe that's sort of like the next fear cycle. That's, you know, that could be like mid-century, you know, 2048, 2049, probably that's similar to what this image is here. I don't know. That's my answer to you. So I just spent 40 minutes. I just gave you my all. Everything that I see there. Francis, I don't know whether that helped answer that question. That's my observation. My core belief is that the 1% is resetting the economy as we speak to get ready for the next growth cycle. Is it as big as this? I think it's going to be. Only time will tell, of course. And so from that perspective, if I'm thinking that this is what's going to happen 10, 15 years down the road, I think that this is cheap, right? We're sort of in this area. Could we still come down and probe against these lows for another year or so? Maybe, but I just don't think so. I don't know. Call me crazy. I don't think so. Anyway. I guess, what would be really interesting is if we looked at I wonder if it's possible to get like a price to book ratio for S&P 500 chart. I wonder if that's possible. Because this would give you sort of the value of these companies. So 2019, 2020, according to this, there's price to sales and the S&P 500. So that's not price to book. Here's price to book. This is unfortunately, well, it's probably 18, 19. That's pretty darn expensive. So I might have to change my tone there a little bit on whether stocks are cheap or stocks are expensive. 2020, so price to estimated sales, price to estimated earnings. So I suppose, just even there, 19.2. 19 times earnings, that's not really historically cheap. They always say single digit PEs, that's cheap. And, when I look at something like this Amazon, and these PE ratios, this is ridiculous. And if I look at price to book, 8.5 times book or 8.75 times book, that's ridiculous. So something like this to me actually looks extremely expensive. So I don't know, maybe through this conversation today, I'm gonna have to change my tone a little bit there and say I wouldn't necessarily call stocks cheap. Like stocks cheap would be down in this area, and stocks expensive would be up in this area. But try and understand that this ratio will go absolutely apeshit through recessions. Because that's when earnings just collapse. And ironically enough, a lot of people are actually calling for a recession in the next quarter or two. So you might actually find that PE ratios go jackknifing higher here. So we'll see what happens. Was that just the peak that you saw there in the cycle? Could be. That would be basically assuming that and the interesting thing is right there is where Mr. Trump's presidency. So you can see clearly they just keep printing. The printing presses are rocking and rolling. We haven't even gotten anywhere close back to Mr. Trump's presidency levels. So if you consider Mr. Trump's presidency, the end of his presidency, fascinating. Notice that that's 19 and then January 20, and we go back to our the Benner cycle, and that exactly was where that peak was supposed to come in. But I guess we don't need to open up that can of worms again. So from this perspective, we're a shadow of what we were under Mr. Trump's presidency, even now. Ironically enough, right? You pull out the M2 money supply and you go, what are you talking about, Brian? We're higher. So there's a bit of an ironic twist. And it just goes to show that I guess they just keep fucking printing money. It's almost like it's unstoppable now, eh? And that's a bit of scary. Could we actually have to come down and test these lows? Maybe. It wouldn't surprise me. I mean, keep in mind, 23 is supposed to be a shitty year too, eh? I mean, maybe what we do is AB. And what do you think about this Biden president? Oh my God, if you thought Trump was bad, this guy's a doofus. So could we come down into 23 and do something ugly like that? Sure. And the irony of it all is that I guess you could even say that's probably a reload zone. There we go. Boomity boom. Boomity boom. Yeah, like that. 78.6 to 88.6. So what this implies is that we may actually even go through those COVID panic dump lows. So I guess from that image, you say, are we cheap? We may be cheap, but it looks like we're going to get cheaper. I suppose you could also argue we've got this A to B there, and that takes us down to there, which is basically a test of these lows. So this is more technical. This is not really fundamental. I guess what's worrisome is if we do fall off a cliff here like this, what would that do to your PE ratio? I would actually think it would make it jackknife back up. So, all right, Francis, are you here? Was that a constructive conversation? I don't know. Did I actually answer the question? I don't know, but I gave it my all. I tried to talk it out. So anyway, there you go. Maybe the Benner dump into the fall will give us the mountain man on things like the stock market, you mean? I mean, the problem here, too, is there's that stupid idiot running around fucking Eastern Europe that feels like lighting off nuclear weapons. What is the world going to look like if half of Eastern Europe is radiated? And you can't live there, and you can't grow any food there. So who knows? We're definitely living in unprecedented times, that's for sure. Interestingly enough, right, when you look at this image, that sure looks like an inverted head and shoulders. The only problem is that low is lower than that low, so that kind of takes that off the table. But I don't know. I don't know whether I would use this as a valuation metric, and what does price actually have to look like to get down into these cheap levels? Because keep in mind, what this image is saying is that earnings are actually very, very strong. Prices of stocks are very, very weak. I don't think prices of stocks are actually that weak just yet. Yeah. I also think, too, that a big part of this conversation, which we might head into, like, it's interesting, I had a horoscope of mine that was done 20, 30 years ago, and it said that I do really well into the 2030s. And after the 2030s, things get quite challenging. You might find that we actually have to go through a 10, 20-year period where stocks and investing and speculating in the market is actually considered taboo. And we might find that, basically we transition into some sort of communist world where guys like me actually don't do very well. So there is that. I could actually see, some people might argue that sure looks like a big sort of head and shoulders top. And we might actually have to go through a period where stock valuations, they fall. Earning streams stay relatively stable. They don't necessarily go up. But we go through a 10, 15-year period where stocks just are constantly on the outs. Nobody's really that interested. And what ends up happening is PE ratios contract back down into these super value areas. I think Warren Buffett, his indicator is basically screaming that the stock market is stunningly overvalued. Let's see, where can we show you that? I guess we can use any one of these. All right, if we go Warren Buffett stock market value indicator. I think it's basically like the stock market versus like earnings. So if you look at composite market value to GDP, so you tell me, is that on the upper end of that image or is it on the lower end? If you look at that image, you go, holy crap, Brian. Stocks really need to take a couple decades off and cool down. So according to that, and the problem here, of course, is that this is looking at stocks not taking that money supply dilution into effect. So stock prices, yes, are at ridiculously high levels, but I could make the argument, ironically enough, you could actually have this fall back down to the mean just by the Fed actually getting some religion and reducing the money supply, which is what they really should do. Ben Graham formula is not flashing many value buys either. Yeah, I would probably argue something along those lines as well. So if you look at it from a sort of a Buffett perspective, this market's not cheap at all. Just my argument, I think, goes along the lines of if you take into account the dilution of the money supply and what is the value of one of these assets, given the total amount of dollars in circulation, I think the image looks like this. If you don't take that money supply insanity into account, then the economy looks like this. I might argue, you see there is 2000. We got a nice healthy contraction in the economy, a nice recession. You could also make the argument too, A, B, C, D. So really the 2008 financial crisis was nothing more than the completion of this correction. And interestingly enough, if we draw a straight line off of those two lows, and that is your healthcare crisis, my hunch is that that actually brings the market back into that level. So if we go just DJI, so take out the money dilution. This is a weekly chart. There is the 2009. I mean, geez, how deep does this have to go? You probably have to go like log scale. That might make it worse. Let's see. Yeah, something like that. So this, and actually what's fascinating, because we even mentioned this earlier. Yeah, you're right, it is. I got to get the hell out of here. Thank you, Nori. Appreciate you keeping an eye on things for me. Well, actually, this seems almost perfectly apropos. So we started off the conversation trying to get Da Vinci back into the fold. And maybe when Bitcoin ultimately bottoms, that's the time for us to have another interview with Da Vinci. So if we believe in Mr. Buffett's indicator, and maybe all we need to do is just come back down to earth. Not exactly what lows. Oh, actually, I guess we'd use these lows here. So that's like 1920 kind of lows. Then there's 20, there's 19, there's 18. Ironically enough, on the site, we used to call this the Da Vinci nightmare scenario. Now, ironically enough, it almost looks like that nightmare played itself out. But maybe what we have to do is something along the lines of going boo to boo. And we got to come down into here. That actually would align nicely with something like shoulder, head, shoulder, neckline. So I actually do like that thinking. Something like that. And then at this point, we'll find out whether Western capitalism is still intact. But wow, either we see a massive contraction in the money supply, or stock prices are going to get absolutely obliterated here. I mean, like literally, and I suppose it makes sense. If a nuclear bomb goes off in the middle of Europe and 10 million people are instantly incinerated, how's the world going to react? You might find that it reacts in some horrific catastrophe kind of scenario. It's definitely possible. I'll tell you, the one thing I absolutely love right now is I didn't get sucked into, I should have been buying down here on that crash, but I didn't. I just stayed in cash. I didn't really get sucked too much into buying too much on the way up. So I am sitting in a lot of US dollars. And ironically enough, if that nuclear bomb does go off, my hunch is everybody in the world will all run into the US dollar all in unison. And that's actually what might create things like these levels getting hit on the dollar. I could very easily see that kind of scenario. So, I mean, obviously, that's not exactly the message we want to end the broadcast on. I will say, just simply put, 22, 23, Benner cycle, it's living up to all the shit that we expected. This is just, it's a train wreck. Now, if somehow calmer heads can, prevail, I actually like the idea that in November, the socialists get kicked out of power. The Republicans come back and sort of start establishing some stability, maybe get the American oil industry back up and running so we can quit with this nonsense about high energy prices. Because frankly speaking, I don't think it's warranted. There's tons of oil out there. This is just nothing more than the socialists want us all to move to electric vehicles, so they're going to inflict as much pain on us as possible. So they go and like shut in all this oil that's just sitting there. And I get the impression that the right-wing political party in the States, they're not buying into this socialist bullshit story. Mark Carney guy, he wants to somehow get the world to guarantee the financing for that $110 trillion he wants invested in moving away from carbon industry towards electric. The 1%, they're really jazzed to really inflict as much pain into us as possible. And I think that's half the reason why energy prices are as high as they are right now. Having said that, can we actually get in? Should we get into the business of predicting the future? I don't think so. If anything, what I would like to see to actually make this a lot easier on all of us, and you all know the answer to this, unfortunately we are seeing it here, but I would make the argument that really, and if you're investing for the future, and probably very similar to, let's see what I wanted to hear, very similar to Bitcoin, I hate to say it, notice this, right down here. Notice this, right down here. Notice this, here. Notice this, here. And interestingly enough, I remember our dashboard indicator when we had it up and running here, it spat out just an incredible buy signal through here. But there's no W's here, which is scary, right? That's a V bottom. This was like a W halfway through the move, and sure enough, that was just a midpoint, right? So flare, flare, and then this move, that's a V bottom. And I hate to say it, but really, and same sort of thing here. This was a midpoint move here. So this is your consolidation. This is the left-hand side of the move. And this is the right-hand side of the move, right? Right up into there. I suppose if you do it on a log scale, it'll be a little easier to understand. So, and actually interesting how we sort of stalled out there and died. So, do you see any W's here? I don't see any. I do see an M. Ugh, yuck. And more M's. And then another sort of market structure fail. A little bit of a W there, but boom, M, and then we just broke to new lows. I don't see it, and if anything, as long as we keep making these V bottoms, then it means we're just going to be, herky-jerking around. If we really want to see a base, right, we got to see down, up, down, breakout. And really what we want to see is stuff that looks like this. And I don't know how long that's going to take to happen, but I tell you, I don't think it's going to happen in this Benner cycle. So 2022, 2023, it's all about lower highs and lower lows. And just to finish this off, if that means that this is sitting at the middle of the range, we're not really cheap. We're not, this is panic, these peaks here, because the economy breaks, earnings just disappear, but the stock prices are still high. And ironically enough, the way that you resolve that is you knock the stock market down. So did they just do that? Yeah, we just had a peak. earnings kind of falling because, of course, the Fed's raising rates, and so now stock prices are getting whacked. The question I suppose you'd have to ask yourself here is the Fed finished raising interest rates? I don't think so. So, and actually Raf on this site recently, he's been talking a bit about this. Really, our job is not to fight the Fed. Don't fight the Fed. You fight the Fed, you're asking for trouble. And, this would be the interest rate market. Actually, I think it's GE1 exclamation mark. So really, we shouldn't get into the business about speculating on the long side until, here's 2019. You can see that at least we bottom, start moving back up. This is what I really want to see is a pretty good looking W. That was after the financial crisis, right? And, okay, we're going to go and bail out the economy. So you can see we're nowhere near any W's. So ironically enough, probably what cleans this up and brings this number down, stock prices keep falling, is the fact that these interest rates just keep rising. As soon as you see this thing W out, my hunch is this thing will start to W out, and then we start climbing back up again. Okay, I think I better shut the hell up. Gonna head off and give the boy a fun afternoon as best as I can. Hope you guys got some value out of all that. I mean, I don't know how the hell I did it, but I just was blabbing away there for 2.5 hours. It's baffling. So I'll leave it at that. Wish me luck with Liam. I love when you guys, send me some positive karma that direction. It helps quite a bit. Welcome aboard all you new level 1ers, level 2ers, level 3ers. Keep working away. Build your trading plans, try and identify setups, try to identify what type of risk taker you are, and get out there and have some fun in the market. I will be away tomorrow. I have a doctor's appointment fairly early in the morning tomorrow, but I'll be back in the saddle first thing Tuesday morning. All right. Have yourselves a great day. PMA for the win. All the best. And the only thing left for me to say is bye for now.